partnership, sales, and distributions. This is problem 1. So let's look first at our balance sheet and our information. We've got 3 partners, A, B, and C. They're all equal partners, so they're all 1/3 partners. On January 1st, the current year, A's outside basis is $250, and A's balance sheet is as follows. So we've got some assets, we've got some liabilities, we've got the capital accounts. All right? So specifically, the question's asking us 2 situations that we can do together. A, what are the tax consequences to partner A if partner A were to sell her interest for $500? Also assume in this problem that the machinery was purchased 3 years ago for $120 and that depreciation has been taken on the building. And also, part of the same problem, P purchases the 1/3 interest from partner A for $500 cash. And the question's asking what is the consequences to the selling partner, and then what's the consequences to the partner that is purchasing the partnership interest. All right. So when we deal with partnership sales, you're selling to somebody outside. You're selling your partnership interest to somebody outside the partnership or a partner. You're not selling to the partnership itself. That would be treated as a distribution. We have 3 steps that we always go through. We always start with the seller. Those are the 3 steps. Sorry, that's what I meant when we talk about the 3 steps. Let me start over. Whenever we have a sale of partnership interest, where you are selling your partnership interest either to a partner inside the partnership or someone outside the partnership join the partnership, you have to apply the sales of partnership interest rules. If you are selling your partnership interest to the partnership itself, distribution rules. So we have to look at the seller and the buyer. With respect to the seller, we have 3 steps that we have to focus on. So step 1 is to determine the section 1001 amount realized minus adjusted basis. So we apply the normal rules of amount realized adjusted basis. Here again, we're looking at partner A. Partner A is selling his or her partnership interests. So what is A getting? A is getting $500 of cash from P. And also, look here. We've got liability relief. Since each partner is a 1/3 partner, profits or losses, we don't know what kind of liability it is. We do know recourse, non-recourse, changes up the profit-loss ratio, how you allocate. We do know that it's the same, right? 1/3 partner, so 50 for each. So A has liability relief of $50. Now so that's amount realized total is $550. Now the basis that A has in her partnership interest is being sold, we're told is $250. But there's another way you can get that. We take the $200 tax book amount under the capital accounts and we add the $50 of liability, we get $250. So A's realized and recognized gain in this transaction is going to be $300. And that's both realized and recognized. Okay, so step 1, we're determining the total gain that A has to recognize. A is going to have a total gain of $300 in net. Step 2 is to determine, step 2 and 3 are breaking down the character of that $300 gain. Step 2 is to determine the portion of the gain that's attributable to hot assets. Hot assets are considered ordinary income assets. Ordinary income or ordinary loss, I should say. Ordinary income or ordinary loss assets. So what we do is we go through each asset on the list of the balance sheet and we look, if the partnership was to sell that asset, would it create ordinary income, ordinary loss? So cash, of course, there's no gain, no loss ever. Accounts receivable is an ordinary income asset, ordinary loss asset. Inventory, always ordinary. Machinery. So machinery could be Section 1231, ordinary through Section 1245. Well, here we're told in the facts, we saw earlier, that the partnership purchased the machinery 3 years ago for $120. And we know the basis now is $55. So what does that mean? That means there's been $65 of depreciation. Because you take the 120 purchase price minus the 55 depreciation taken, you get 65 of depreciation. So that is depreciation recapture. We're going to do the lesser of the realized gain or that. So we'll keep that in mind. Building. When we depreciate the building, which we're told we did over the last 5 years, does that create depreciation recapture? No, it does not. Unless you purchased the building before 1987, which that one is not the case here. Stock, that is not ordinary income asset, and goodwill, internally generated because it's zero, not internally generated asset. So we got three assets that are what we call hot assets. The reason why, and this is a phrase we use in the tax law, we call them hot assets, are because these are the assets that are going to create ordinary income and sometimes ordinary loss, but usually ordinary income. And ordinary income for taxpayers, individuals, bad, right? So these are hot assets, like a hot potato, okay? So this is what we do in step 2. Remember, step 1, it's a total gain. Step 2, you must recognize the partner's share of hot asset, ordinary income, or ordinary loss that the partnership would have had to recognize if it sold it. So we've got these three assets. We've got accounts receivable, we've got inventory, and we have machinery. We basically treat it as if the partnership was going to sell these assets, and the amount realized is going to equal the fair market value, total. So accounts receivable fair market value is 60, inventory 150, and machinery 100. Minus the adjusted basis. So minus 75 for just basis for accounts receivable, 90 for inventory, and 55 for machinery. We get the gain the partnership would have to recognize if it was to sell these assets. Well, we actually have a loss for accounts receivable. Look at that, 15. Inventory, 60. Machinery, 45. Now again, when it comes to ordinary income recapture, which is what we're focusing on here for hot assets, it's the lesser of the depreciation taken, which was 65, or the $45 realized and recognized gain. So of course the 45 is the lesser, so that's what we use. We then are going to take our partner that's leaving or selling the interest, their share. So A has a 1/3 interest, so we take 1/3 of that for A's portion. And we get a -5, 20, and 15. We then sum them all together. When we sum these all together, we get positive 30. This is A's share of ordinary gain. So A has, in this transaction, $30 of ordinary gain. Finally, we get to step 3. Step 3 is the easiest step. We take step 1 minus step 2. So step 1, we have a total gain of $300. Minus step 2, 30 gain. We get $270. This is a $270 capital gain that A takes on. It would be long-term capital gain if A held a partnership interest for more than a year, short-term for a year or less. So you notice that 270 plus 30 is 300, and that's exactly how it works. The amount of gain that A recognizes in step 1, you're breaking out the character, ordinary in step 2, capital in step 3. By the way, it's also possible to have a loss in step 1, gain in step 2, and even bigger loss in capital loss in step 3. That actually happens sometimes. You can have all different types of scenarios, but it has to net out to that amount. So those are the consequences of the seller A. With respect to the purchaser, P, we're told that again that P pays $500 cash. So we need to know two things. What is P's outside basis? And we also need to know what happens with respect to the partnership to P. So P's outside adjusted basis is the $500 paid. Sorry, I put 5,000. My apologies. Plus, remember, there's also liabilities. You always have to allocate liabilities when it comes to partnerships, plus the $50 of liabilities. So this equals $550. So P's outside basis is $550. Now, the other issue is that in terms of P, what happens with respect to the partnership? So there's no Section 754 there's no Section 754 election in place here. Because there's no Section 754 election in place, all that happens is we cross out A and put P over it. So literally, P steps into the shoes of A with respect to the partnership. Yes, P does have a $550 basis in his partnership interest, so if he was to sell, he does use $550 for the adjusted basis. However, when it comes to the partnership, if the partnership sells property or does something, all this stuff stays the same. So if the partnership was to sell the accounts receivable, inventory, or machine the next day, guess what? P would have that ordinary income or ordinary loss. Okay? Or if P sold his or her interest the next day, P would have, guess what? $30 of ordinary gain and $30 of $30 of capital loss. So one way that we fix this is to make a Section 754 election. What a Section 754 election does is it remedies this situation. It adjusts all of the assets on the balance sheet up and down by 1/3 the fair market value in the basis. So what I'm saying is that for the accounts receivable, we would decrease the adjusted basis by 1/3 of the $15 difference, the $5 that we saw. So the basis would go down to 70. The inventory would go up to 110, and the machinery would go up to 70. And then what would happen is if the partnership sold those assets, P would not have any gain on those assets. B and C, though, would, their share of that. And that's how you would do it. We would also adjust P's tax book amount to $500. So it'd be $500. The other partners would stay the same. And that's the end of this respective problem.